3-minute trader tip, trading the market breadth. We often talk about how the market resembles a living entity simply because prices are driven by overall market psychology and sentiment. So when we're referring to trading a market breadth, we're essentially referring to a bounce strategy. Often price trades between two key price levels. For a period of time, the market is in congestion, not sure to go to the upside or the downside, but spends a period of time trading within a range. It raises the question, can this be perceived as the market breathing? It has its main thrust and subsequent exhaustion points when there isn't enough evidence to change sentiment and take it out of that range. And is this why support and resistance are such strong concepts? If we look at this Canadian dollar yen chart on a 30-minute, you can see here an example of what we've been talking about. So price has moved into a range here between 99.15 and 99.98. You can see it move up, exhausting, coming back down again to the same level it was at before. Then we get the thrust and we ultimately get some exhaustion. We get another thrust before ultimately, of course, we get a breakout. So can we take advantage of this thrust period when we have got a bounce off a key level, either off the support to the upside or off the resistance to the downside? Now this gives us a good example here, and if we look at the price action, what we've got is a few things going on. First of all, we've got a pause of the price at this support level. We've even got a test through it and a candle that's rejected it, and subsequently this move higher. What we see is ultimately an engulfing candle which takes out the previous bearish candles here and is supported by increased volume, closes at the top third of the candle, and then subsequently moves up. And of course we'd have our profit target sitting just below this level, which will be triggered here. So is this the ideal setup? So we get an engulfing candle in the opposite direction. So for example, a bounce off support, an engulfing green candle, or a bounce off resistance, we get an engulfing red candle, closing in the top or bottom third, depending on whether we're going long or short, and with associated volume. The challenge for you now is to go away and write a very basic trading plan based on that concept. Add any other indicators that you think may be appropriate and add to your game. But one of the other considerations you've got to do is considering your minimum tradable distance. That is the distance between the support and the resistance on whatever time frame, on whatever instrument you're trading, to make sure that it's going to give you at least a 1 to 1.5 or even a 1 to 2 risk-reward ratio. Trade safe, and we'll see you again soon. Bye-bye for now.